BMWs selling for the price of a BYD. Welcome to the new reality of China's trade war with Germany. In 2025, a BMW 5 Series in China can now be had for the price of a mid-range BYD electric sedan, something unthinkable just a few years ago. Showrooms slash 20 to 30% off luxury German cars, not because demand is booming, but because it's collapsing. The buyers haven't disappeared, they've switched loyalties. The shift isn't just about cars. It's a symptom of a much bigger economic fight. Over the past 2 years, China and the European Union have been trading blows over tariffs, subsidies, and market access. Brussels accuses Beijing of flooding the market with subsidized electric vehicles. Beijing responds with threats of import duties on European luxury goods, autos at the top of the list. For Germany, the consequences are sharp. BMW, Mercedes, and Audi, icons of engineering prestige, built their growth on Chinese customers. Now, those same customers are turning away, and the pricing power that once defined these brands is evaporating. Almost for free doesn't yet mean Beijing owns these companies, but it does mean the market is valuing them far less than before, and that is its own kind of loss. Background: Germany's dependence on China. When German automakers first entered China in the 1990s, the relationship was almost textbook win-win. China needed world-class engineering to modernize its roads. Germany needed a massive, fast-growing market to offset slower sales at home. Joint ventures with local partners, such as BMW with Brilliance Auto and Volkswagen Group, parent of Audi, with FAW, gave German brands access to Chinese factories, workers, and most importantly, consumers. By the mid-2000s, China wasn't just a growth market, it was the market. For BMW, around 33% of global deliveries came from Chinese buyers. Mercedes-Benz depended on China for roughly 36% of its sales. And for Audi, the figure was even higher, at over 40%. Profits from Chinese customers often subsidized R&D and kept plants running in Germany during slower European cycles. The trade ran deeper than just cars. In 2023, China was Germany's largest single trading partner for the 7th year in a row, with two-way trade worth over 250 billion euros. Alongside automobiles, exports included machinery, chemicals, and industrial components critical to China's own manufacturing base. For decades, this was a mutually reinforcing system. China gained prestige products and industrial know-how. Germany gained reliable revenue and market scale. That balance held until trade tensions, EV subsidies, and tariff threats started to tilt it sharply in Beijing's favor. The rise of Chinese trade wars. In today's geopolitical economy, Chinese trade wars aren't fought with ships or soldiers. They're waged through tariffs, retaliatory duties, market access controls, and industrial policy. The pattern is clear. When Beijing's exports are challenged, it answers with targeted pressure on sectors that matter most to its trading partners. The European Union became a primary front in 2023 when Brussels launched an anti-subsidy investigation into Chinese-made electric vehicles. EU officials argued that state subsidies, ranging from cheap financing to discounted raw materials, were allowing companies like BYD and SAIC to undercut European car prices by up to 20%. For German automakers heavily dependent on the Chinese market, this inquiry was a political gamble. Beijing's counter was swift. Officials floated tariffs on European luxury cars, especially high-end models from Germany, along with agricultural products and even aviation components. The signal was unmistakable. If Europe moved against Chinese EVs, China would hit back at industries it knew were politically sensitive in Berlin, Paris, and Brussels. This trade friction fits neatly into Beijing's dual circulation strategy, an economic doctrine aimed at boosting domestic consumption and innovation while reducing reliance on foreign suppliers. Protecting and promoting its own EV makers not only strengthens China's industrial base, it also weakens foreign competitors' foothold in the world's largest auto market. For decades, German car makers could count on China as both a growth engine and a profit center. But as the trade war deepens, that engine is being rewired to power Chinese brands instead, leaving Germany's champions fighting for relevance on terrain they once dominated. The first shots: tariffs and consumer sentiment. first tangible blows of the EU-China trade tensions were felt in the price tags of German cars on Chinese showroom floors. When Beijing hinted at imposing retaliatory tariffs on European luxury vehicles, even before official rates were set, importers began preparing for higher costs. Dealers faced a choice: pass those costs on to consumers and risk losing them entirely, or slash margins to keep cars moving. Most chose the latter. By early 2025, discount wars were in full swing. BMW models were selling for as much as 25% below their official list price. Mercedes-Benz was offering cuts of around 20%. Audi dealers, desperate to shift inventory, went as far as 30%. These were unprecedented concessions for brands that had built their reputations on exclusivity and price discipline. But pricing was only half the problem. Since the escalation of trade disputes, patriotic buying has become a visible trend. Government-linked media and influencers have praised domestic champions like BYD, NIO, and Li Auto, framing them not only as technologically competitive, but as symbols of national pride. In this climate, choosing a foreign brand is increasingly framed as outdated or even disloyal. The result is a double hit for German automakers: shrinking market share and shrinking margins. Discounts may keep some units moving in the short term, but they erode the very prestige that allows luxury brands to command premium prices. Once customers start expecting luxury for less, it's a race to the bottom that even the most storied German nameplates may struggle to win. Market share collapse in China. The sales figures tell the story more starkly than any political statement. In the first quarter of 2025, BMW and Mini deliveries in China fell 17.2%, compared with the same period a year earlier. Porsche's drop was even more severe, down 42%, as high-end sports cars lost their shine in a market pivoting toward electrification. Mercedes-Benz managed to limit its decline to around 10%, but that still marked a clear reversal from years of consistent growth. Audi, once the default executive sedan brand in China, suffered a double-digit slide, though the company has been less forthcoming with exact numbers. Meanwhile, the competition is moving in the opposite direction. BYD's sales in China surged past 3 million units in 2024, giving it a dominant position in the new energy vehicle (NEV) segment. Chinese brands as a whole captured more than 50% of the domestic auto market for the first time, a symbolic tipping point that would have been unthinkable just 5 years ago. Trade tensions have accelerated this shift. EU investigations and potential tariffs on Chinese EVs have prompted Beijing to double down on domestic subsidies, from generous consumer rebates to tax breaks for EV manufacturers. At the same time, threatened or actual tariffs on European imports make foreign cars even less competitive in price-sensitive segments. For German automakers, the problem is not just a temporary sales dip, it's a structural market realignment. Once a brand loses share in China's fast-moving auto industry, it is exceedingly difficult to win it back, especially when the rival products are cheaper, government-backed, and increasingly viewed as technologically equal or superior. Strategic weaknesses of German automakers. German automakers are not losing ground in China purely because of tariffs or subsidies. They are also suffering from strategic missteps. Chief among them is the slow transition to electric vehicles. While BMW, Mercedes, and Audi have invested heavily in EV technology, their rollout pace and model variety lag far behind Chinese rivals. BYD, NIO, and Li Auto launch new models every year, often with cutting-edge features and competitive pricing. Equally problematic is the lack of affordable mass-market EV options from German brands in China. Their electric offerings tend to cluster in the premium segment, leaving the fastest-growing mid-priced EV market almost entirely to domestic competitors. In a country where EV adoption is driven as much by practicality and cost as by status, this is a missed opportunity. The prestige of German combustion engines, once a decisive selling point, has diminished under China's carbon-neutral agenda, which aims for peak emissions before 2030 and carbon neutrality by 2060. High-performance petrol sedans and SUVs are increasingly seen as relics of a fading era. All of this is compounded by an over-reliance on Chinese sales to sustain global profits. In some years, China has accounted for more than a third of total deliveries for BMW and Mercedes. Losing that volume doesn't just hurt market share, it disrupts the financial backbone that funds R&D, marketing, and production across their entire global network. Buying them for free. Almost for free is not yet about Beijing writing a check for BMW, Mercedes, or Audi. It's about a slow erosion of value that makes such a move increasingly plausible. China's dominance over the EV supply chain is at the core of this pressure. From battery production, where Chinese companies control over 70% of global capacity, to rare earth minerals essential for electric motors, the cost structure of every EV sold in China tilts in favor of domestic manufacturers. German automakers pay more for the same inputs, shrinking already thin margins on their electric models. Speculatively, this could lead to more joint ventures in which German firms, struggling to maintain market share, agree to deeper Chinese participation. Majority control could shift subtly over time, starting with production decisions and extending to technology sharing. If sales continue to decline, distressed asset sales are possible. Factories, local distribution networks, or even licensing of proprietary platforms might be offered to Chinese partners at a fraction of their peak value. That's when almost for free stops being metaphorical. A prolonged squeeze, lower sales, higher costs, weaker bargaining power could leave even the most storied German brands vulnerable to acquisition or heavy strategic dependence. In a trade war where industrial policy is as much about control as about competition, that outcome is not a fantasy. It's one possible endgame: wider economic consequences for Germany. The stakes go far beyond a few struggling car brands. The automotive industry accounts for roughly 5% of Germany's GDP and supports more than 800,000 direct jobs, plus millions more in related sectors: parts suppliers, logistics, engineering services. For decades, steady Chinese demand acted as a stabilizing force for this industrial base, cushioning downturns in Europe and North America. If that market continues to contract for German brands, the effects will be felt first in domestic factories. Lower exports mean production slowdowns, temporary plant closures, and eventually layoffs. The pain won't stop at the assembly line. Thousands of smaller suppliers, many of them family-run firms, depend on steady orders from BMW, Mercedes, Audi, and Volkswagen. A drop in output quickly translates into bankruptcies across the supply chain. The shock would ripple across the EU as well. Countries like Slovakia, Hungary, and the Czech Republic, which host German-owned plants or supply components, would see their own industrial output and employment take a hit. In an economy as interconnected as Europe's, the collapse of one sector in one country rarely stays contained. For Germany, the trade war with China isn't just a distant geopolitical dispute. It's a direct threat to one of the pillars of its economy. If the Chinese market slips permanently out of reach, the consequences will be counted not just in lost sales, but in lost livelihoods. China's strategic playbook. China's advantage in the current trade war isn't accidental. It's the product of a coordinated industrial strategy. At its core is aggressive subsidization of domestic EV makers. Companies like BYD, NIO, and SAIC receive a mix of direct financial support, tax breaks, discounted land, and preferential access to raw materials. These measures lower production costs and allow domestic brands to sell at prices foreign competitors can't match without eroding their margins. Beijing pairs this economic policy with political leverage. By targeting tariffs or restrictions at sectors critical to foreign governments, such as German luxury cars, it applies pressure far beyond the showroom. The message to Berlin is simple: cooperate or watch one of your key industries suffer. On the consumer side, Chinese automakers have shifted the narrative from catching up to leading. Domestic EVs increasingly offer advanced driver assistance systems, AI-powered infotainment, and battery ranges that match or exceed foreign models, all at lower prices. This makes the patriotic choice not just emotional, but practical. Finally, joint ventures remain a strategic tool. While foreign carmakers gain market access, Chinese partners gain technology and manufacturing expertise. Over time, this technology transfer can narrow and even erase the gap between domestic and imported offerings, leaving the foreign brand with fewer unique selling points. It's a playbook designed not just to compete with global leaders, but to replace them, especially on home turf. Future scenarios. The best-case scenario for Germany's automakers is a negotiated easing of trade tensions. A compromise could involve reduced tariffs on both sides, a scaling back of subsidies that distort competition, and expanded co-development projects between German and Chinese firms. Such arrangements might preserve market access while allowing technology exchange to remain balanced rather than one-sided. The worst-case scenario is far starker. In it, German brands become niche luxury imports in China, appealing to a small, wealthy clientele but irrelevant to the mainstream market. Their former dominance would be replaced by domestic champions controlling every segment, from budget commuters to high-end electric sedans. Losing China in that way would also weaken their global position, as reduced revenue erodes their ability to fund innovation and compete elsewhere. What's unfolding is not just a fight over tariffs and sales, it's a contest for control over the future of mobility. Whoever wins China's EV market gains both the scale and the supply chain influence to dictate industry standards worldwide. Right now, that momentum belongs to Beijing. Germany's luxury car makers, once unchallenged on engineering prestige and global reach, are discovering that in the world's largest auto market, they no longer set the terms. They're negotiating from a position of weakness, and they're playing by China's rules. What do you think was the most shocking news? Let us know in the comments. And if you found this interesting, hit that like button and subscribe for more jaw-dropping stories.